check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday. John Penn joining me this morning. We're going to talk about some client issues today, and one in particular is what to expect when you actually go talk to a financial advisor. There's a lot of misconceptions about financial advisory firms and kind of how they work, and they're all different. I have to state that, but you should have a set of expectations, and we'll kind of go through what those expectations are, because it's kind of like going to a doctor in a lot of ways, and people don't go talk to a financial advisor because they're afraid of stuff. We'll get into that this morning. Nothing to be afraid of. Anyway, so a couple of things relating to the markets. We've got a little bit of economic data out this morning, nothing huge. Walmart reported earnings this morning. Just disclosure purposes, we own a position in Walmart in our portfolios. Stock's going to be up about 4.5% this morning at the open. We recently trimmed in Walmart going into earnings because it's up like 65% this year. It is now the new AI stock, I guess, for shopping and retail sales. But they announced very good earnings this morning and said that they are moving very close, their e-commerce business moving very close to profitability. So that's giving the stock a fairly big boost this morning, and that's going to kind of help that retail sector. Overall, the futures are pointing a little bit lower this morning. We had a nice little bounce yesterday coming out of the markets, and we had come down and kind of tested support, rebounds. We'll talk about that in a minute. Yields are a little bit lower this morning as well, very oversold. So again, a lot of the stuff that the market's going through, the S&P is down about 14 points this morning. It's very potential it could reverse by the time the market opens. But again, we're in that, as we talked about last week, the markets had this very big run up, post the election, and we're just expect some chop here over the course of the next couple of weeks. There's not a lot of data. We don't have a lot of earnings data. We're wrapping all that up. The big earnings report is tomorrow. That's NVIDIA. So, of course, that's going to be the market mover. I believe they report after the bell tomorrow. Don't quote me on that, but I do believe they report after the bell tomorrow. But that's going to be the big mover on Thursday for the markets, and particularly in the semiconductor and AI space and all those. So all eyes are literally on NVIDIA's report. But the top 10 stocks in the S&P 500 now make up about 27% of the entire global market cap. So we've gotten just very, very big, large companies. In the month of September, this data runs on a bit of a lag because it's collected from foreign investors. But foreign investors put $121 billion into U.S. stocks in September, and they bought another $43 billion worth of treasury bonds in September. So, and this has been a continuing trend here by foreign investors. Foreign investors are piling into the U.S. market. U.S. market cap now makes up about 60% of the global market cap. So everybody wants to be in the U.S. market because that's where the money's getting made right now. And again, this is a lot of when we get to see these recent upticks. We're into that phase of the year, November, December, where we're going to start getting all the forecasts now for 2025. Goldman Sachs, Morgan Stanley out this morning. Mike Wilson, who's normally extremely bearish on financial markets, he's been expecting a bear market for like the last 5 years now. Finally kind of acquiesced. His base case for the S&P is now 6,500 in 2025 with a bull case of 7,400. So we're starting to see even the most bearish analysts are now becoming more bullish on the markets, and expectations of a recession are now gone. There's literally nobody expecting a recession anymore in terms of the analyst community. But over the course of the next few weeks, and we do a report every year, we come out and we get like the top 10 predictions for the S&P for 2025, just so we can kind of see how things turn out. This year, those predictions were way too low. The market's done a lot better than what analysts were predicting last year, so we'll see how, they're never right, one way or the other. Analysts are never right, but we'll see how that goes. But that also kind of feeds into today's kind of commentary and article that is on the website talking about predictions. We'll get into that. Ed Yardeni, as we talked about recently, just recently stated that the S&P could reach 10,000 by 2029. So we'll talk a little bit about that, the drivers, and is it different this time? We'll talk about that. Let's talk about the market. Here's what you need to know before the bell this morning. The market came down yesterday, touched the 20-day moving average, bounced off that. We're going to test it again today at the open. Again, it's going to be important to see if the markets can kind of hold on to this level. This is kind of that running trend support that we've had now, really kind of going back for the last couple of years. The market tends to run right along that 20-day moving average. When it cracks it, that's where you get these little short-term tests of the 50 or the 100-day moving average. But that's been really the overall kind of trend of the market now. Again, going back to October of 2022, there's only been one occasion really in the last 2 years where the market even approached the 200-day moving average, and that was back during the yen carry trade blow up in August. We had that 8.5% decline. But outside of that, the market tends to really kind of just continue to remain contained in this kind of upward trend of the markets, staying between the 20 and the 50-day moving average for the most part. No real risk here at the moment, as we've talked about, just kind of really going into the end of the year. We're about halfway through a correction, at this point. So again, the market's got probably a little bit more work to do to finish working off some of this overbought condition. We are very close to triggering a sell signal. We'll do that today, most likely. And again, that just suggests that it doesn't, that doesn't mean that markets are going to have a big decline. It could, but usually doesn't mean that. It just means that upside is likely limited. So we might see a little bit of the market being capped here for the next, week or two as we kind of work through the holiday shortened trading, et cetera. And as we talked about before, markets tend to do better between the post-Thanksgiving holiday and about the second week of December. And then we get into mutual fund distributions, then you get your year-end rally, for the Santa Claus rally. So again, kind of expect some volatility here. Expect a little bit of chop. Not a whole lot to really worry about. We've got the Fed meeting December the 18th. That's expected to be a 25 basis point cut. That's kind of where the risk lies. In terms of if they kind of come out and become a little bit more hawkish here. But again, with oil prices remaining suppressed, that's going to feed into inflation. That's likely going to keep inflation kind of tamped down right now. One of the big things that we're watching for between now and the Fed meeting is going to be retail sales numbers. If there's concern about the strength of the economy, strength of the consumer, that's going to potentially, kind of push the Fed to maybe, be a little bit more dovish in terms of their language. They're not going to change their rate cut at this point. It's only 25 basis points, but they kind of moved their language a little bit more hawkish at the last meeting. So if we see some weak economic data, kind of expect that language to come back to be a little bit more dovish. And that could be supportive of markets through the end of the year. But again, that's mid-December, and that'll be just past the mutual fund distribution. So I'll be kind of setting us up for that year-end Santa Claus rally. So just kind of something to pay attention to. Outside of that, markets are fine. We had talked about previously picking up a small position, a starter position in small and mid-cap stocks going into next year. They've had a nice decline coming back down to the 20-day moving average as well, just like the markets. They had a big spike. They've pulled back here a bit. So again, probably getting a much better opportunity here, but it needs a little bit more time to kind of process here. But again, kind of working off that big overbought condition we had, coming back to support as well. So again, kind of give this a little bit of time, but I think you'll have a little bit better shot at adding a little bit more small and mid-cap stocks to the portfolio for as we move into 2025. And again, just kind of watching that business sentiment. That's what you need to know before the bell this morning. When we come back, we'll pick up with John Penn. We'll talk a little bit about predictions, the problem with predictions, and also what to expect from a financial advisor if you go talk to one. Talk about that coming up on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So coming up this week on the website, by the way, if you haven't been by the new website, we launched our new handy-dandy version of the realinvestmentadvice.com website. Move things around a little bit just to make things a little bit easier to navigate to. All blogs and posts, newsletters, etc., all under the resources tab now. So if you go to realinvestmentadvice.com, click on the resources tab, drop down menu, everything you want right there. So you knew I was going to write this article. When Yardini came out and recently stated that the S&P go to 10,000 by 2029, I was going to write an article on this, right? I mean, there's some layups you just have to take, and this is just one of them. But so he comes out and he makes this prediction. He says, based on the rise in animal spirits, and we'll talk about what that means. But he says, based on the rise of animal spirits, we're going to have this roaring 20s in the 2020s. It's going to be like 1920 all over again. And so far he's been right? So, I mean, it's been a pretty decent, well, it's kind of sort of decent 2020 period so far. We did have a bit of a 20% correction along the way, but market's been pretty good since. So, it's not bad. Markets are higher since we've turned into the 20s. But if you remember the 1920s, this was the golden age, right? This is where we were industrializing America. We formed Henry Ford started the automobile production facilities, and the economy was booming. Everything was booming. U.S. is doing fantastic. We just come out of a depression, by the way. in the early 1919. So coming out of that, the economy was roaring back, and we did great from 1920, right? Till 1929, things were fantastic. So Ed Yardeni says this is the new version of the 1920s, and we're going to have this rip-roaring market for the next, 9 years. Now, so I formulated out a monthly chart. So this is a chart of the S&P going back to the 2009 lows and just projecting out as he did. You can see there's a very clear trend line that the market's been trading in now for the last, since last 15 years, so since 2009. It's just been within a very defined trend channel. We trade to the top of it, we trade to the bottom of it, then we go back to the top of it, and it kind of runs right along the long-term moving average. So again, markets have been very bullish, and they've been in a nice bullish trend since the financial crisis, which you would expect, right? We had this terrible financial crisis, 50% down on the markets, and so you've been recovering ever since. Exactly what you would expect. So he's just saying basically the market's just going to continue to grow this at 7% for the next, several years, and we'll get to 2029 and we'll be at 10,000. So first of all, just a sideline of that is that the market's been growing at 15% on average for the last 15 years. So 7%, from here isn't that big of a stretch. It may also be rather disappointing if you're used to getting 15 to 20% a year. 7% a year may not seem so exciting. But as always the case, there's other drivers to the markets that happen over time. And, that this is going to be one of the issues that we'll have to deal with. But, the problem with long-term predictions is that we have these predictions all the time. And in fact, in the late 90s, Ed Yardeni himself, the same person, was saying, hey, we're going to have this rip-roaring bull market to S&P 5,000 back then. And of course, it didn't quite work out that way. And then he was also very bullish back in 2007. Brent, you can bring this chart up any day you want now. There you go. Thank you. So back in 99, he had these predictions that were going straight. And then 2006, 2007, same predictions. It wasn't just Ed Yardeni. It was all forecasts, right? Goldman Sachs and Morgan Stanley is like, oh, we're in this bull market. Everything's fine. We're just killing it. And the problem is that we ran into problems, right? And you had fairly big drawdowns in the markets. And one of the coincident factors is kind of in that bottom of the chart, which is a long-term monthly relative strength index. And you'll notice that whenever that relative strength index is extremely overbought, you typically run into trouble. And every time that even in the last 15 years, every time we've gotten a bit overbought, like we are now, you've run into a decent little correction along the way. But eventually you're going to have a mean reversion, right? That's just a function of how markets work over time, and we'll eventually get through that process. But let's talk a little bit about Yardeni's kind of point, and specifically what he brings up is talking about animal spirits. And animal spirits is a term that comes from the Latin, it's spiritus animalis, which means the breath that awakens the human mind, right? And so basically what they're talking about is these animal spirits is this mental psychology of the markets where everybody's all bullish and we're very optimistic. And we've talked about, valuations, and the problem with valuations short term, everybody's like, oh, valuations are very expensive right now, is that they are simply just a reflection of consumer sentiment. So again, that animal spirits is just a reflection of valuations and consumer sentiment. And everybody's very optimistic about markets right now. Consumer sentiment is rising. So that's what you would expect. And that was ultimately applied. So that Latin, which was from 300 BC, was ultimately applied by John Maynard Keynes in his 1936 publication, The General Theory of Employment, Interest, and Money, and kind of adopted that idea of animal spirits being a process that grows the markets over time. And Ben Bernanke was famous for picking this up again in 2010 when we did the second round of quantitative easing. So in 2010, when the Fed did quantitative easing part 2, this was a statement that Ben Bernanke made at the time. He said this approach being quantitative easing, eased financial conditions in the past and so far looks to be effective again. Stock prices rose and long-term interest rates fell when investors began to anticipate the most recent action. Easier financial conditions will promote economic growth. For example, lower mortgage rates will make housing more affordable and allow more homeowners to refinance. Lower corporate bond rates will encourage investment, and higher stock prices will boost consumer wealth and help increase confidence, which can also spur spending. Animal spirits. That's all that is. And so when he was talking about this, again, we can see, just graphing this out on consumer confidence. Whenever we imputed these type of monetary interventions, whether it's through lower interest rates or whether it's through economic supports, et cetera, we got big boost to consumer confidence. And whenever consumer confidence was extremely elevated, that was where that animal spirits was all kicking in, kind of on full steam. Now, right now, consumer confidence is suppressed because the Fed hiked interest rates, right? Made housing unaffordable, made cost of everything, borrowing money was more expensive. Now that the Fed's cutting rates, and they're not doing it aggressively yet, but they'll get to that point, is to boost consumer confidence to spur economic activity. So as the economy continues to slow, it'll reach the point to where the Fed becomes more aggressive on monetary supports. Remember, the Fed's still doing QT right now, and they'll eventually do QE to lower interest rates and to spur more spending. So that's still coming. But again, the economy's got to slow down a little bit more before we get there. And that's just going to happen. But here's the problem ultimately with all of this process. And this is really twofold. So what this chart shows you is quantitative easing and all the money that we've done, right? So this is HAMP, TARP, HARP, federal, you name it, right? All of these Federal Reserve interventions. So we increased a lot of activity in the economy, but if we just look at the Fed's balance sheet, right? So the Fed says, hey, we're gonna buy bonds, lower interest rates, and that's going to create all this other economic activity. Well, it did. We created a lot of speculation in the markets, but did we really do anything about spurring better economic growth, right? Stronger economic growth. And so if you take a look at the total percentage of increase in the Fed's balance sheet, that's the blue bar on the left, right? So the Fed's balance sheet increased by 869% to date. So this is through current from 2009 to last Wednesday. The Fed's balance sheet is up by 869% from the lows. Wages only grew by 65%. So it didn't translate into stronger wages. The Fed's balance sheet action didn't translate into stronger wages. In fact, we spent $13.22 of government dollars buying back bonds to barely increase wages. If you take a look at full-time employment, we increased the balance sheet by 869%. We only increased full-time employment by 19%. So we spent $45 per job on the balance sheet. If you take a look at corporate profits, they're up, the Fed's balance sheet up 869%. We increased corporate profitability by 179%. So and GDP is only up 103%. So if you just, all these interventions, right, it didn't translate into massively stronger economic growth. And so what happened was it did inflate asset prices. And this is where we got the wealth gap from. This is where people that had money to invest benefited from it. And yes, it did increase economic activity somewhat, but the investment made in increasing that economic activity really didn't justify it. And this is the problem with this idea of the Roaring 20s, because in the Roaring 20s, we had prosperity being built across the entire economy. People were manufacturing, they were producing, they were investing, they were doing all these things. And now that's not really so much the case. And importantly, when we come back, we'll wrap this up talking about borrowing from the future. And this is the risk that Ed Yardeni's prediction runs into, is that we have pulled forward all this consumption and we're running high valuations. So we'll talk about how this potentially all works out right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My son, Thomas, who really good-looking kid. And so he's starting a business for Thanksgiving to provide Thanksgiving packages.
The Real Investment Show
For
podcast.
$75, he'll show up at Thanksgiving, with a girl and tell a cute story of how they met. They'll stay through dinner and then, give the parents a hug on the way out.
Same show, your schedule.
Quite a business idea. I wonder if there's a package in there where he wears the matching ugly Christmas sweater.
At realinvestmentadvice.com.
No,
to the
that's
family, too.
that's the Christmas package.
That's the Christmas
That's
deal.
coming up.
Okay,
So
got it.
yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I had somebody ask me what was the dumbest thing I ever did, and they made two mistakes. One, they assumed that I've already peaked. Second is I did stay up and watch the Tyson fight the other night.
I'm right there with you. I did. I mean, I even kept our daughters up too.
I think that had to rank up there with one of the dumbest things I've ever done.
We all woke up Saturday morning, and our daughters are 22 and 24, and they looked at me and they just said, "Dad, that was awful."
Yeah.
I said, "I know. I'm sorry.
Yeah.
I was right there. I was hoping, but
You know what?
I'm right there with you."
Dude, there's more excitement watching both my dogs wrestle over a bone than that fight.
I'd rather watch the squirrels in the backyard. Are you kidding me? Man.
So anyway, all right. Just wrapping this conversation up about predictions, and this is the problem with predictions going forward. And really, this one chart really kind of sums it all up. Over the last 15 years, we have been borrowing from the future. We have done $47 trillion worth of monetary interventions across the board, and we're assuming this is normal. right? We're assuming that the market action since the 2009 financial crisis lows is normal. But if you take a look at, as we were showing you, the growth in employment, the growth in wages, the growth in GDP certainly doesn't support the growth in asset prices that we've had. And again, it's fine. I mean, if you're invested in the markets and you're making money, this is awesome, right? I mean, there's nothing wrong with it. I just think you have to be a little bit aware that this has been a function of a massive amount of monetary interventions that we previously have not done before. And in order to keep that going, right, you've got to kind of have, some sort of the same type of underpinnings going forward to keep this current experiment in its current process. But right now, the market's returned over 300% from the 2007 peak. So and yes, if you go to the March 2009 lows, it's like 450%, right? So, but from the 2007 peak of the market, we're up about 300%. But sales growth, and I use sales growth, not earnings growth, because earnings are very much manipulated through buybacks and accounting gimmicks, et cetera. Sales is a little bit harder to manipulate. You can do it, but it's not as easy. Sales growth is only up about 100%. So we've increased the market valuation, right, price, by 300%, but we've only increased sales by 100%. GDP growth is up to about 40%. So, the market has far outpaced what the economy can actually generate. So the economy generates, activity, and that creates sales, and there you go, right? So how do you keep that going, right? That's going to be ultimately the big question, and we kind of talked about this the other day a bit, but when we take a look at corporate profitability as a percentage of GDP, that is a level that is just unsustainable at this point. It's never been at this level. It's been a function of the COVID pandemic bailouts. It's been a function of shutting down the economy, creating inflation that was able to pass through because we gave people money to spend. Sustaining corporate profitability as a percentage of GDP at this level is going to be very difficult. And so when you start talking about these kind of future growth predictions in the economy, Brent, I'm going to change charts. This becomes a little bit more difficult, and particularly when we start looking at corporate profits relative to wages. And wage growth has not kept up, with the economy. Corporations have been able to suppress wages through productivity increases. Now it's going to be AI, et cetera. But, but those wages are what economic growth is built on. And so if wages aren't rising to a degree to keep up with, to spur stronger economic growth, then it's going to be more difficult to maintain valuations going forward, and particularly corporate profitability going forward as well. So, the point is that when we get back to, these ideas that we're just going to have this incredible market growth for the next 10 years or until 2030, and it's going to be fantastic. It's very possible. I'm not saying it's not possible that we can't have just a bull market continue for the next 5, 6, 7, 8, 9 years, right? But when you start looking at valuations, the underpinnings, and start looking forward, if the government, and then I've got an article coming about this on Friday talking about tariffs. If we start doing things to decrease government spending, and the idea of the Department of Government Efficiency is it will trim $2 trillion off the deficit. That's where all the corporate profitability has been coming from, is savings, or actually dis-savings by the government and dis-savings by households. That's where these are coming from. And I've got an article on the Kaliki profit equation coming out. We talked a little bit about yesterday, but we'll get into that. But just the point here is to be a little bit cautious about the future and these rather ebullient forecasts, because they do eventually fail. And they tend to fail in a rather spectacular fashion. It failed in 1929. Remember, in 1929, Irving Fisher, we've now reached a permanently high plateau for stocks. That was it. 1999, 2007, now we've got predictions for S&P 10,000. So again, they tend to fail. Just have to be cautious about it. All right. Anyway, enough of that. That article is all on the website with all the relevant charts, data, et cetera. Just be a little careful jumping onto these long-term forecasts because, again, like I said, they tend to turn out wrong.
Well, and it tends to sway you from a risk tolerance standpoint. I can't tell you how many conversations I'm having as of late where now the election's over and there's a winner and we're going to have a new president sworn in office in January.
Lots of excitement.
And it's just like all of a sudden that folks that used to be a little bit more on the conservative side, I want to take a more cautious approach. Hey, John, I'm more of a conservative to moderately conservative investor. All of a sudden, man, it's like game on. Mm-hmm. And we want to take a lot of risk. It's like, okay, well, what's the knee-jerk reaction here? Does this warrant really changing your own risk tolerance? Does this warrant changing kind of who you are as an investor, right? And I think it's very easy to look at some of these predictions too to just say to yourself, well, hey, I'm so accustomed to seeing markets having such strong returns here as of late. That's what everybody's trying to figure out is what is the market going to do moving forward? What sort of return expectation can we achieve? And I think it's great with that's why in our financial plans, right, on a forward-looking basis, when we're trying to forecast, okay, here's where you are now, where do you want to go? Let's use some forward-looking rates of return just for planning that are more on the conservative side.
Right.
Because we don't know maybe the market does give us historical returns moving forward. Hey, if that happens, great. But if it doesn't happen, what sort of rate of return do you really need for this all to work moving forward? If you need, 10, 11, 12% a year for this to work, that's a different conversation when it comes to planning, right?
Mm-hmm. No, that's right. But again, this is why, we go through these things and we talk about
right.
these issues is because we tend to forget that markets are variable.
Right.
And what is working now won't work in the future. And we forget about these things. We get very comfortable with markets that are rising and we say, okay, this is going to continue forever. And just remember that they don't.
Yeah, or as markets are rising, markets get a little complacent. Sometimes I hear this too, Lance. Hey, John, I'm a conservative investor. I'm just going to take a conservative approach to this. I'm just going to go put all my money in the Standard & Poor's 500 index. It's like, okay, hold on. When did an all-stock index fund become a quote-unquote conservative investment? Let's take a deep dive in here and let's really explore this a little bit. Yeah, you're going to be happy in 2021. You're going to be happy this year. What about 2022? How'd you feel then? Right? You gotta think about this. So you just kind of take a step back, and I get my hair starts going up a little bit on the back of my neck when I start getting those calls. I'm just going to be a conservative investor and put all my money in this Russell 2000. It's like, okay, let's talk a little bit about that first, right?
Right. Well, I mean, this is, again, this is where it comes back to kind of understand, but this is also the other problem. Again, we talked about animal spirits.
Yeah.
And it's interesting that, again, like you said, let's do a 100% index
right.
as a conservative investment. But we also start making these assumptions that the returns that we're getting now are completely normal. And this is the point that, I kind of go into this article in a little bit more detail,
yeah.
is that we're assuming that what we've seen over the last 10 years is normal economic and market activity. And it's been anything but normal economic
mm-hmm.
activity over the last 15 years, because of just multiple rounds of fiscal interventions, monetary interventions on scales we have never seen historically. We've never seen these types of interventions from either central banks or governments ever in history. And we're now assuming that that's completely normal activity. And maybe it is. Maybe this is just the new paradigm we're in, and
sure.
It's just going to be we'll do another $47 trillion over the next decade. The question is who's going to pay for it, right?
Yeah. And that's you're talking about the animal spirits and just emotions. I mean, it's the unknown, right? We're all trying to somewhat predict the future here. And unfortunately, nobody knows. But, to your point, it seems like this time feels very... To me, that some of the conversations I'm having as of late, it feels very 1999-ish, 2000-ish, where, right before the, kind of the tech bubble, it was, well, these are the rates of return I expect. Well, hey, 20% a year, that's kind of the norm. And it's like, well, hold on a second. Let's just take a step back and, really look at what the market's done over the past and why. And let's have some more realistic or let's have an open mind about what the future may hold, right?
When we come back from the break, I want to discuss a little bit about, if you're considering going to talk to a financial advisor, right? What should you expect out of that meeting, and what should you think about going into it? Again, we're picking up a lot of misconceptions lately, and really kind of a lot of bad statements being made by people about what they're expecting from a meeting. We'll get into all that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I was just telling the guys on the break that my wife has come up with a new business venture. She's been trying to figure out a TikTok channel to start because, you know, all the kids are doing it these days. Everybody's on TikTok now. And my wife loves to bake. She's a very, very good baker. So she's come up with the idea she's going to start a TikTok channel called The Baked Baker, where she'll take a THC gummy, wait 30 minutes, and then bake cookies.
Considering the cookies?
Considering my wife has ADHD to start with, it can be nothing but hysterical. So if I get this channel launched with her, I will make sure and tune you in because it'll be nothing but hilarity. And I probably wouldn't eat anything that comes out of it.
Are we going to have some samples here at the office?
Absolutely. Absolutely. So, all right. You're thinking, look, a lot of people just manage their money on their own. We get it. It's easy to do. Just buy an S&P index fund. Don't worry about it. It just goes up over time, apparently, and you really don't need a financial advisor for that. So why pay the fee? Mm-hmm. And I think, and we've gone through this before, you know, what are you really paying for? And this is the one thing that you should evaluate. You know, if you do hire an advisor, a financial advisor, it's not just some guy to manage your money. You don't need them for that. Again, just buy an S&P index fund and you're going to be okay. What you need the financial advisor for is to advise you on all the other financial mistakes that you're making or will make. And again, we've seen a litany of these, whether it's taking Social Security too early, you know, not preparing for Medicaid, Medicare, you know, all these things, right? Estate planning issues. You know, people die without a will and it's a huge mess. Happens all the time. Mm-hmm. So that's what you're paying a financial advisor for. It's not for the portfolio management. That's a very, and I've told you before, is like, that's my job is the least important job of everything we do here at RIA Advisors because I just manage the money part. That's not the important part. It's all the other stuff. So, but John, I think there's a big misconception when people go to meet with a financial advisor, kind of like what that meeting is supposed to be and what's supposed to happen. So I thought you could maybe go into a little bit more detail from the way you do it, at least.
Yeah, sure. No, and by the way, what you do and the team do on the investment side is just as important as far as how we look at things here. It's a collaborative effort.
We just buy an S&P index fund and hold it. That's all we do. Yeah.
Right. Just roll it on the Russell 2000.
I spend most of my day playing Call of Duty, so that's...
You're about to be baking soon, too, is what it sounds like.
And baking, yes.
Yeah, so a lot of questions I get are, and first and foremost, when you're reaching out to an advisor, just that decision alone to reach out, to have that conversation, that's a big step. Right? I mean, that's an emotional decision that you have to make. We're like, okay, I think I'm ready to have a conversation with an advisor, or maybe you're going to visit with a number of different firms. And you should visit with a number of different firms because every firm has a different approach to this. There's not a right way or a wrong way to, manage assets, look at financial plans. I mean, I've seen some things out there where I go, that maybe there's a better way to do this. But at the end of the day, every firm's going to have their own approach, a different philosophy with this. And you have to find the firm, you have to find the advisor, the fiduciary, important word, the fiduciary, where your philosophy matches with theirs. I think that is key, right? But just having that moment where you realize, okay, I do need to reach out for some help. That's a big step, right? So a lot of times when I'm about to have this kind of initial exploratory conversation with somebody, I just here recently, I got an email before our visit here in a couple of weeks is, hey, John, would you mind kind of explaining what we're going to talk about in this first discussion? Is this a quote unquote standard sales pitch? What are we going to be talking about here? My response was, there's nothing salesy about it. It's just a conversation. What I really want to do is learn about you. What are your questions? Where are you in life right now? Where do you want to go? Let's talk about your family. Do you have children? Let's talk about them. What about mom and dad, parents? Do you have other loved ones that you need to support financially? Ideally, at the end of the day, what is the type of assistance that you're looking for? And is our approach on how Lance and the team, how they manage investments, how they manage risk, how they're managing the portfolio, and how we approach planning, is there a good fit from a philosophy there? And either we're going to be a good fit for each other or we're not. There's no hard sale. Sometimes after I visit with somebody that's maybe visited with some other firms, they say, golly, Lance, I feel like I've just somebody tried to sell me a car, right? That's not what we want to do.
Right. No, I mean, I think that's such an incredibly important point because, I remember when I first started out.
Yeah. Oh, I did
too.
In
the business, right?
Oh, I did too.
And you're just like, I remember when I landed my first $100,000 account. I was like, oh man, I've done it, right?
Yeah.
And fortunately, now we've grown to the size that we don't need to sell product to be in business, right? And so now we can, and this has been the case for a long time. It's been this case ever since I joined RIA Advisors, back in 2015. We don't need to sell product. We don't need to sell services. If you want to use us, that's fantastic. We'd love to have you, but we don't need to. And it puts us in a fortunate position that if we don't have to sell a product, then we can just do what's right by the client. It's, there's no quotas. Nobody has a quota. Nobody has any requirements to do anything other than provide really, really good service to the client, make sure they're taken care of, and make sure you're doing the right thing for them. And, we do a lot of stuff for free.
Yeah.
A ton of stuff for free because we just want to help people.
Well, I think when you're working, when you make up your decision to work with an advisor, I find that the educational peach. See, I think about baking.
I know.
Like peach cobbler or something there. Oh my goodness.
Baker.
That educational piece, I think that's pretty important. We all like to teach. We all like to educate here, whether it comes to Social Security, Medicare, kind of like Rich says, kind of the alphabet soup of Medicare. What does all this mean and how does this work? I can't tell you, Lance, how many times I visit with folks who are maybe working with an advisor and they're looking to make a change. And when I ask them, okay, well, how does your advisor, how are you invested? What do you own? And the answer is, I have no idea. I don't know how this works. I don't know why I own what I own. I don't know why I ever had this investment, but they just went with it. Right. I will tell you here, or if you're working with me, like Lance said, there's no hurry. It's not like I had a new client ask me just recently, hey, as soon as we start working together, you guys are going to start investing my money right out of the gate. And I said, no, you and I are going to sit down and we're going to visit and we're going to talk. And that can be one conversation or several. I said, before we start investing any of those dollars for you, if you don't have an understanding around what a bond is, what an exchange traded fund is, or the companies that we own, and here's the reason that we own them, not that you have to understand 100% of it, but I need you to have a good understanding of here's what we want to do and why. And when we are both on the same page together, and I feel like you have a good understanding about what that approach is, then we're going to start, right? And then what I like to do is a couple weeks after, when we do start that investment strategy for you, I like to come back to you in a couple weeks just to say, hey, Brent, hey, Lance, hey, here's what we've done so far. Does this make sense? Do you have any questions about it? And if so, let's talk about it, right? At the end of the day, these are your dollars. You need to have an understanding of what your money is doing and why, and how does this all tie together within that financial plan? Where are you going, right? Let's take a look at it from a holistic standpoint. So, there's nothing salesy. There shouldn't be really anything salesy in those initial conversations that you're having with an advisor. And sometimes folks will tell me, hey, John, I'm just letting you know I'm visiting with multiple firms. My response is, that's good. You should. Because maybe we're not the right fit for you. Maybe we are, but you gotta take your time and explore that out there, right?
Absolutely. So again, these are all kind of the things that people need to be aware of. And you go prepared for your meeting, right? If you're gonna go sit down with an advisor, take your financial statements and have a good idea of where you are and what your goals are, and have a good productive time out of it, kind of learning about your financial situation and what the risks are to your financial outlook. And, just don't show up and go, oh, I'm here to manage my money. That's not what a good financial advisor will do for you. And again, that's really kind of a good separator. I mean, if they come in, they're just trying to sell you an annuity right up front. Oh, this is going to solve all your problems just being an annuity. That's probably not a good advisor for you.
Yeah. And I think sometimes the conversations start, I think when folks kind of reach out to an advisor to begin with, it's very focused on portfolio management, right? It's, hey, let's have those conversations about stocks, bonds, exchange traded funds, how do you manage risk, et cetera. But then the conversation will kind of blossom into some other, what I call larger areas of risk management in their life. And you touched on this a little bit earlier, Lance, and that's estate planning. Do you have a will? Are you in a state where the cost of probate is really expensive? Does it make sense for you to have a trust? Okay, do you own rental property? How are those registered? Are those in your name? Do you have those in LLCs? What are you doing if somebody is in your rental property? They may be a great tenant, they may be a friend, they may even be a family member. What if they slip and fall and hurt themselves on that piece of property? What if they decide to get litigious? How have you protected yourself against that potential issue?
We talked about a lot, yep.
So let's, I think there's a lot of time and energy and focus on the investment management piece of this. Stocks, bonds, what's your ratio of stocks to bonds to cash, and how do we manage risk there? But I can't tell you how many times I visit with couples that are a little bit more, as I say, a little bit mature with their investing. They're a little bit older. Maybe they're in their late 60s, early 70s, mid 70s, late 70s. And I ask the question around, hey, what sort of estate planning have you done? And everybody looks at each other, and then they look at me with those big eyes. So like, we haven't done that. We've been meaning to do that for the last 20 years. I'm like, well, that's where you need to start. Let's focus on that.
Exactly. Like a will.
Yeah.
All right. Hey, thanks for all the great ideas for merch line in the chat, because I've made notes of a few of these. There's some really good ideas. So that's a product line maybe for next year. We'll work on that. Anyway, have a great day. We'll be back tomorrow with Danny Ratliff here for the Wednesday edition of the show. We'll get you up to date on the markets and your money, etc. See you back here tomorrow. Have a great day.